All right, well, good morning and welcome to Bonhoeffer Capital's Q3 Q&A conference call. We really had a great response when we hosted a similar conference call last quarter, so we're very glad to offer this opportunity again, and we thank you each for taking time to join us today. In addition to discussing some of Bonhoeffer's specific holdings, Keith will be detailing some larger market observations and historical trends he continues to analyze. So before Keith jumps into things, just a few housekeeping items. First, this presentation is for informational purposes only and is not intended to constitute a sale, solicitation, or advice. If you're an accredited investor wishing to learn more about the partnership, please reach out separately. And additionally, throughout the presentation, Keith would love to open it up for Q&A. You can do that by raising your hand in the, within your chat window, or submitting a question directly in the chat. He's happy to take that, in the flow of the conversation. So once again, thanks for joining us. And Keith, I'll hand it over to you.
Okay, great. Thanks, Jessica. Well, welcome everyone. Hopefully you guys it's a bright, sunny, nice, unusually warm day here in Rochester, New York, and I guess afternoon for folks that are in Europe. But yeah, what we're going to do is just go through some observations I've been making, talking a little bit about the portfolio. And as Jessica said, if you have any questions along the flow, just let me know, and we I'll respond to them as we go through this. So initially, let's see. Our typical disclaimer statement, this is for informational purposes only, as Jessica stated. And so just an overview of the Bonhoeffer Fund and sort of where we are at, some of the trends that we're seeing right now. It was started in 2007. Our initial strategy was value with special situations in emerging and developed markets. There's two areas that we've sort of evolved into or incorporated more into our strategy. The first one is consolidation and transition sort of frameworks. And so basically the focus of this particular theme, and we talked about it a little bit in the last quarterly update, was to focus on sort of growth drivers and sort of slower growing markets in consolidation and transition. And what we see there is the market may be growing slow, but there's companies within that particular market segment that are growing fast. And what we've seen is that markets don't price that in. And one way you can take a look at that is if you take a look at the long-term charts of a number of these types of businesses, they go up and to the right, which basically is saying that the market's not incorporating this information in going forward. And a lot of it has to do with mergers and acquisitions. And it's common practice amongst valuation and sort of folks in the investment community not to incorporate mergers and acquisitions into their projections. But some of the companies, that's what creates a lot of the value. And if you don't put that in there, you're missing a big piece of it. And then the final piece is just there's been some opportunities from this recent interest rate adjustment. To give you an idea of sort of what's happened is the interest rates have gone from, let's say at the end of last year, a minus 0.8% real. These are the tips, to 1.8% real. And in combination with that, the short-term rates have gone up, and it's created some really interesting opportunities. Whereas in the past, from that perspective, so here's sort of an overview here. So we reset to positive from negative real rates. Bonds and stocks have declined both at the same time. Now, this is a relatively rare phenomena in markets that has happened a few times in the past, and we'll take a look at that and what sort of happened and where the opportunities were at times in the past. Now, what you've got here is history rhymes. There's not going to be exactly the same, but we can take some observations of the past to find where we think are interesting areas currently in terms of expected returns of different types of asset classes. So the other thing that's been common amongst when they both declined is there's inflation present. At this point, the future is uncertain. Given the nature of the inflation, a lot of it is, from what I see, supply side driven as opposed to demand side driven. Actually, the Federal Reserve of San Francisco has a pretty good breakout of this, where they break out the inflation between supply side and demand side, and they estimate that the supply side is twice the demand side. If you basically focus on factors that are only demand side, the net inflation is probably closer to 3%. But a lot of it is supply side, and a lot of it has to do with the supply chain disruptions associated with China, because a lot of our goods and services, goods primarily comes from China, and any disruptions in that is going to create some additional inflation on our side. And we're dealing with that. I mean, we sort of see the imbalances and how hard this thing is really to balance, where we've had a lot of goods that came in and now we've got a surplus of goods. And that's why you're seeing like sales at Amazon and sales at Target and sales at Walmart, because they just had too many goods and they basically have to clear their goods out for the Christmas season. So this balance after a shock, like either a war or an epidemic, is a very difficult thing to sort of balance out correctly. And that's sort of what we're in the midst of right now. And one sort of top level thing to look at, I think, is, okay, well, we've gone from negative real rates to positive real rates, but where are we in context of the long-term history of interest rates? And this is sort of a study recently completed by Rogoff and Schmelzig, who basically looked at long-term rates. Now, Schmelzig's looked at long-term rates going back to the 1300s. And what he's found is that rates decline by roughly 0.16% every 10 years. And in addition to that, and you get this regression line. And the reason for that is that what's happening is it's a question of when does capital get destroyed versus accumulated. So in times of peace, capital gets accumulated. It becomes bigger and bigger, and the number of opportunities out there to deploy the capital is somewhat fixed. Now, it may have grown, for example, recently with the opening of a lot of the autocratic countries to become more democratic. But what happens is that unless there's a war or either an epidemic or plague that kills a lot of people, capital continues to accumulate. And that's what this chart really shows, is that over time, capital is accumulated. And that capital accumulation leads to lower real rates. And this current regression basically shows that right now the real rate should be, based upon this long-term trend, about 0.7% real. Now, if you look at tips, the rate's around 1.7% real. So we're above that point. So what's really happened is there's some really interesting opportunities, I think, in fixed income now, given sort of what's happened there. And then if you go further down the credit spectrum, if you can get a good underwriter that basically has some decent, basically the opportunities for a good underwriter in this market are very, very good. So here's sort of the implications of this, what we're calling an interest rate adjustment. The first is rising real rates, again, provide well underwritten financials opportunities to generate above average profits if rates stabilize or go down. Now, a way to think about rates, at least the Fed seems to be tied to this, is that it's tied to inflation. And so the question of will rates come back down, in my mind, is really tied to, do you think inflation is going to come back down? And if you believe inflation, according to the Fed of San Francisco, is supply side based, inflation should come down and therefore rates should come down. And this is basically a time to sort of reduce demand. But what will happen eventually is once the inflation comes down, then interest rates will follow. And so that's sort of, at least I think, what's going to happen going on in terms of having prolonged inflation. Last time we had prolonged inflation was in the 1970s, and that was caused by a large amount of shortages of oil. Now, right now, we've got oil is up there, and the production side of it is less. So we have a similar situation, but not quite the same, in the fact that the world economies are not tied as much to oil as it was in the 70s. But the real question is, okay, will oil prices stabilize? Which I think they will. The wild card in this, of course, is the Russia and Ukraine. I mean, Russia is such a large oil producer, but it does look like Russian oil is getting out into the market. So that's going to affect the world prices anyways. So it's getting out into the market through either India and or China buying the oil. So it's not like it's sitting there and not doing anything. So I think inflation, in my opinion, inflation will come down. So the areas I think that are interesting right now in terms of the this rise in real rates is there's some certain areas of stress. There's high yield, and you can get some of these business development companies now where you can get yields. Now, business development companies are in essence holding companies that hold a bunch of floating rate notes similar to bank debt, but they have a tendency to be clients that are smaller, and therefore their credit ratings are a little bit lower than what banks can hold on their balance sheets. So if you look at ones that maybe underwrite at, let's say, a B or a double B rating, right now you can get yields in those companies at current yields of 10%. But what's happening is, since their floating rate and so forth has gone up from 0.8 to 1.8, excuse me, 0.8 in Q2 to almost 3 to 4% in Q4, you're going to get a very large increase in the distributable income for these for these particular companies. And I think you'll probably get somewhere in the low teens in terms of distributable amounts from that perspective. So the BDCs are very interesting. Another one is sort of niche lending. So companies like Credit Acceptance for auto, they've got a really good record in that. That's going to be an area where there's going to be a lot of stress. And then commercial real estate guys like Hingham that focus on just very niche people. What's really interesting now is that if you take a look at the rates of return on some of these investments, they're becoming competitive with some of these growing compounders, which if you go back 12 months ago, they were not, because the interest rates were really low. But as interest rates go up, bonds and these bond type instruments become more competitive with stocks, which we haven't seen since before the great financial crisis in terms of it really being competitive. And probably even the last time we saw a real large increase in these was before the dot-com boom, when the interest rates were a lot higher. And so we're seeing a reversion to that, so that we're dealing with this sort of adjustment process at this point. So one thing I did is I said, okay, let's go back and take a look at similar times in the past where we've had rising real rates, falling stock and bond prices that are accompanied by inflation. And there's three major periods. If you go back and you take a look at, I took a look at the data that DeMotorin had sort of put together, and where these three things happened. So the first one was post-World War II. So in post-World War II, the economy, similar to what we're doing now, switched over from, whereas in COVID, everything was shut down and we had to restart it, post-World War II, you had to retool because we were making defense goods. And then now we're retooling to make consumer goods. And just typically when that happens is you have a lot of inflation. You'll see in 46, 47, that's what happened. And in addition, you saw that real T-bonds and real stock returns were lower, which is what we're seeing right now. So we're probably in the first of a 2-year decline in this. And sort of where these periods of time happen to be 2 years when these things sort of happen. So first one was post-World War II. The second one was post-Vietnam and the Arab oil embargo, 73, 74. You had a similar set of negative T-bond and real stock returns. You can see those there. That's probably within the memories of some of the older participants in the market. The post-World War II, it's probably in no one's memory at this point from that perspective. And then the third period of time was during the Iranian Revolution, which created some additional sort of negative returns. And so if we take a look at those are the three times, let's say post, in the, post Great Depression when this thing happened. Now, the one thing I've noticed, which is interesting on Twitter, is a lot of people say this has never happened before. But part of the problem is that people's database doesn't go back this far. A lot of the databases I've seen people talk about goes back to the mid-90s, but there are times when this has happened before. The other thing I did, I said, okay, this has happened before. What have investors, good investors, done in those times? And so there were three or four sources. And if you guys are interested in this, these are probably good sources for you to take a look at too, in terms of what happened during those times. So the first one is Buffett's letters. So he wrote some letters to his shareholders in the 70s. There's some information there, not probably as much as maybe some of the other sources, but it does provide his insight into what he thought was going on at the time. Another one is a book called John Neff on Investing, which is basically, it's a compendium of what his overall investment thoughts were. He's got an investment diary in the back that goes from 1971 to 1989. Now, John Neff is well known as a value investor, and value investing did really well post 73, 74. And you can take a look at what his does, and we'll talk about some of the observations that I've made in terms of reading his material. The other one is this book called The Money Masters by John Train. He wrote his first edition in 1980. And so that will give you some snapshot of what people thought was going on in the 70s in this higher inflation times in terms of what are some interesting opportunities. And then the final one is Ben Graham's last version of The Intelligent Investor, which was written in 1973. And so that gives us another view of, okay, these are areas where these investment masters thought were interesting at the time. And right now, if you look at a lot of these areas are very similar in terms of places to look. So Buffett's focus at the time was he purchased high return on capital, capital light firms that were royalties on product and service growth. Now, these are things he bought a lot of TV stations, newspapers, and advertising agencies as an example of this. And I think this is an example we can look at today. Okay, what type of business? Then the advantages of these businesses are they can pass on inflation to their customers, and basically they're capital light, so you're not investing a whole lot of capital in them. And so these are examples of sort of what he did in the 70s. Now, John Neff is another investor there, and he sort of focused on different types of growth during this period of time. He broke it up into what he called less recognized, moderate, and cyclical growth, and invested in those types of firms throughout the 1970s. There's a nice graph in the book where he sort of breaks out the types of companies invested by percentage of the portfolio invested. So what he did with some of the cyclical growth, these were commodity and consumer companies that were doing now the catch with cyclical companies is you have to basically know when the cycles are going, but those are some ones where he did relatively well during that period of time. He also focused on what he called moderate growth companies. These were companies with less than 8% growth with decent yields. And then there was the third group, which was the largest one, which really created a lot of his return, and those were less recognized growth. These were 12 to 20% growers, single digit PE, high ROEs, and participation in a defined growth area. And you'll see in our portfolio, we have a number of these types of situations in our portfolio. So if we go back and we look at sort of lessons learned from these masters. So first of all, Ben Graham in his 1973 book talked about bonds trading at a discount to par. Now, with interest rates going down, that really never happened, but it is happening now. And the advantage of bonds trading at a discount to par from a tax perspective is that even though the interest is ordinary income, the cap gains, the appreciation is cap gains, so you'll get a tax advantage. And he did talk about, like, Ben Graham also talks about how, like, what happens with bonds that are good money, they have a tendency to move towards par as the maturity date gets closer. And so there's a natural tailwind for those kind of situations. And I think that's, you notice that today in a lot of bonds that have come down quite a bit. So if you look at, let's say, bonds that are 5 or 10 years out, say less than 5 years out, you'll see a natural gravitation towards the 100 point as the thing's going to be paid off. So it's an interesting area to look at. He mentioned in his book also savings bonds. He basically had what he called special situation bonds. And the one that he really looked at was savings bonds historically in the books. Today, I think an interesting one is I bonds, because you can buy I bonds and get a guaranteed at this point 8% return over the next 12 months. You have to lock up your money for a year, but the maximum amount you get is 10,000 per person. So that's another sort of parallel today. This was also time where he talked about net nets, which were the 2/3 of net working capital value situations. He did talk about deep value stocks, and what he meant by that were companies that were sort of in single digit multiples, and then workout situations. In all these investors basically at the time talked about the trade-off between bonds and stocks. Now, we haven't necessarily had that discussion very much recently because bonds have always traded at this huge discount to stocks in terms of a cash flow basis, probably even after the great financial crisis. Bonds were never really that competitive with stocks. Now stuff has changed and they are becoming more competitive. And so if we take a look at some of the trade-offs that some of these guys did, Buffett recommended municipal bonds when he closed down his partnership, which at the time were yielding 9% on an after-tax basis. So that gives you a rough idea, 6.3% on a post-tax. At that time, inflation was running around 6%. So on an after-tax basis, that these were the types of things that, but it peaked up and come back down. But that's just sort of an interesting benchmark if you look at what Buffett was recommending for some of his partners that decided not to go with the Sequoia fund or invest in Berkshire Hathaway. And then John Neff also through his diaries had mentioned times when he felt it made sense to go with bonds versus stocks. He felt when real returns were greater than 5% for bonds, stocks were going to have a tough time. And so those are sort of interesting benchmarks. We're not there right now. We're probably between 1.75% and 2% real. But if we do get there, bonds may be an interesting way to at that point it becomes more competitive with stocks in terms of returns. So in terms of investment implication, right now, bonds, they're more competitive with stocks than they've been in the past. I think one way that we've been looking at is to find well underwritten high yield loans / bonds. And so those are things I think that we're examining at this point, and that's an area of high interest for us now in terms of where to deploy funds in when new funds become available. On the second, in terms of stocks, shorter duration value stocks should do well. Opportunities in stocks of efficient and well underwritten financial firms, that goes back to the bond and overall interest rate sort of situation where those particular situations are becoming pretty well now, well compensated, let's call it that. The interesting thing about the theme we talked about previously, and we'll briefly go over again, is consolidation growth can add value independent of rates. And so that's value where companies are rolling up companies and with defined synergies so that the value of the firm continues to go up. So what I'll do is, Jessica, do you have, let me just see. So yeah, why don't I?
Keith, we do have a question.
Okay, well, why don't you do that, Greg? Because unfortunately, in the frame I've got, I don't have access to the chat. So
Sure,
that would be
yeah,
great.
no problem. So Reno's asking, what do you mean by short duration value stocks? Can you speak to that?
Yeah, so the way to look at short duration versus long duration in terms of stocks has to do with the fact that what period of time will the cash flows that are going to be discounted at occur. So value stocks have a large amount of cash flow currently in the next few years versus like growth stocks. Growth stocks will have most of their cash flows in years that are out further than, let's say, the next 2 to 3 years. And depending upon interest rates, you can think about it from a duration perspective, is that when interest rates are low, long duration assets, which are long-term bonds and growth stocks, go up. And the reason is because lower interest rates in those times drives those values up. When interest rates are higher, shorter duration assets on a relative basis become more valuable because the longer term cash flows are discounted at a higher rate when rates go up. So it's a relative comparison of the value versus growth stocks. Okay. Is there any other questions, Jessica, or is that?
That's it for now.
Okay. All right. So now I'll jump on. This is for those who saw last quarter. This is primarily, we're going to be talking about the similar sort of concepts that we did last time in terms of consolidation, just to give everyone an overview of where we are and what's going on with that. So consolidation works really well when you've got a fragmented market. And that's something that we've sort of been trying to focus on at Bonhoeffer, is finding these fragmented markets where people can roll up companies and get identified synergies by doing that, and management teams that have experience in doing this. And then also looking for companies whose multiples are relatively modest. So we're talking about multiples probably less than low than 15%. And so that's sort of the framework that we're looking at these companies in. And what's really happened in a number of these markets, first of all, these markets are initially fragmented, but then the internet has added additional fragmentation in these markets. And so basically there's a balance between online, offline, and omni-channel demand. And so what we try to do is we try to choose the best of these particular companies across markets and geographies. And these are some examples of companies that we're invested in right now that have some of these characteristics. Equipment leasing like Ashtead in the US, automobile distribution. At this point, we've got, we actually have Asbury in the US. Home decor value retailing, At Home was one of our positions that was bought out last year, but it had some similar types of characteristics. And in connectivity, we've got Consolidated Communications in the US. One of the things we try to take a look at is, okay, we've got a number of incumbents in these markets. You've got competitors, or basically new guys that are coming in the markets trying to disrupt it. Who has the advantage in that game? Typically, it's the incumbent. Now, the challenger can do well if they can disrupt the value chain, and the incumbent can't react by basically, using his or her value chain to basically try to blunt that. But we try to find situations where the value chains are not destroyed to the point where the incumbents still have a decent advantage in that competitive situation. So these are various options that people can do in terms of this consolidation. And so these are various options that people can do in terms of when you get these fragmented markets and when you've got disruption. And so depending upon the specific situation, if you think the disruption is such that it's going to destroy your value chain, the best thing to do is to spin the company. If there's some synergies between the two, then you want to keep them together, that there's significant market and sales overlap between the companies. An example of that in our portfolio is a company called Thrive. Now, Thrive is a small business SaaS company, which also owns a lot of Yellow Pages business. On the surface, you think, well, these things really don't have much overlap, but in fact, they really do, because a lot of the Yellow Page business customers are small and mid-sized business customers that are a perfect fit for the software that Thrive is developing. So that's an example of where, since they have a common set of customers, it makes sense for them to stay together. Initially, the company came out of bankruptcy, and there were a number of players that wanted the company to spin off the software business from the Yellow Pages business. But that didn't make a whole lot of sense given the customer bases. But again, this is all specific depending upon the specific situation that the company's in at the time. And so here's some examples of sort of like different options. You have fiber connectivity replacing copper. In that case, you've got some incumbents that can do well, like Consolidated Communications versus, let's say, some of the upstart guys that are. The interesting thing about Consolidated Communications is their footprint is so dispersed, and that provides a lot more protection from them versus other guys where the footprint is more consolidated and competitors can get scale a lot quicker and basically can provide more competition. And one of the key things we look at a lot of, especially the telecom areas, look for places where there isn't competition, because whenever there's competition in telco, it really can create problems for the businesses over the mid and long term, sometimes even in the short term. Content distribution is another example of this. Another one of our companies, Scripps, basically focuses on over the air and connected TV. So they're part of that particular universe. And what's interesting is Scripps can actually make more money through connected TV, despite they need to actually share some of that CTV revenue with, let's say, somebody like a Roku, since the CPM rates are 2 to 3 times, even after the sharing, they're ahead by doing it. It's an interesting aspect of that business. And then the auto distribution moving online is another example where what's happening is you've got some of a company like Asbury is really sort of incorporating that. It has local clusters and places where it services, and then online is just an additional sort of channel that they can use within these clusters, and therefore creates a lot of value sales for very little incremental cost. And so that's sort of the examples of sort of options of how companies can deal with disruption. And so there's basically, these are more models that other people have put together. If you're interested, these are some interesting resources that you can take a look at. So these are guys, Scott management has put together this sort of overview of consolidators, roll-ups, platforms, accumulators, and holdcos. Where our focus has been primarily more on the roll-up versus the platforms and accumulators. Some people, I think Scott and other people, have focused on the platform and accumulator aspects of it. And then there's the holdco, which is more just like some of the holdcos like Lucadia, Bolare, IAC. I mean, there's different investors you can see that focus on different aspects of this, but we primarily focus on the roll-up. I think that is where, since my strength has been primarily sort of valuation, we can go to the next thing here. You can take it, this is a really good one because it says where is the risks in each of these particular sort of models. And one of the key risks in roll-ups is valuation risk. And my background has been in valuation. And so I think we have a good way of, we have a way of trying to sort of assess that risk. And there's other sort of companies that have other types of risks associated. So I think the key thing behind this chart, I think that's important, is just taking a look at the risks and finding out, okay, where do you think you can assess those risks, let's say, the best? And Bonhoeffer, I think we can assess the risk best in the roll-up area. You get basic synergies, but then the real question in the roll-up area is people paying too high of a purchase price, ruining the economics of that particular situation. And these are just more of, okay, this provides a benchmark of what kind of return on capital should you get depending upon size. The general picture here is showing that as the companies get bigger, the return on capital goes down lower, which I think makes sense. I mean, we're trying to focus on more towards the left-hand side, dealing with smaller companies acquiring other types of businesses from that perspective. Okay, and so what we're going to do is this is Asbury as an example of one of these types of businesses. And what I'm going to do here is I'm going to go through these. These are primarily the thesis, which we went over last time. In general, the general thesis is for Asbury, it's a consolidator that has really good historical growth. The projected growth, I think, will be relatively good if it continues to follow the same model. And it really creates some interesting dynamics in terms of future cash flows. Overlaid on top of Asbury is the auto supply chain disruptions. And what that's really doing is it's really creating a lot of, for a while, there wasn't that much demand because the chip shortages. Now, as the chip shortages sort of unwind, there's going to be a good amount of supply that's going to basically be there. And how is that all going to play out? I've heard different stories on that. I mean, I've heard some people say, okay, well, the chip shortage is basically going to be resolved. I've heard other people say it's going to last a number of years. But I think that the overall sort of cyclical aspect of the business is overlaid on this growing company, and that leads to a lot of noise. And we'll sort of see going forward how the market is valuing each of these types of businesses as a result of sort of this macro shock that's really associated with any auto distribution kind of business. And so again, these are just sort of the thesis stuff. You can go back and take a look at them. We discussed them in the previous valuation, but in essence, I think I gave you sort of the snapshot thesis of why this company is interesting. Historically, it's done well. It continues to do well, and it's basically consolidating, and it still has a lot of market that it can consolidate. And so some of the key aspects of the business as it stands today, the last time we did this, the numbers on these were lower, and it's actually gotten better as time has gone on. So the debt interest rate's now 8.3%. I think it was lower the last time we looked at it. Common stock trades at 4.1 times adjusted earnings. You add the earnings growth and the yield together, you're getting a 35% number there. We compare that to the bond spread, we're like at 14%, which is pretty good. And then, the EV to EBITDA is definitely modest. Some of the challenges here, people talking about changing service needs for hybrids. There are sort of people you can take a look at that's at the front end of this. Bilia being a Scandinavian company, that's the front end of this transition. They continue to do relatively well. So, I mean, the nice thing about the automobile service business is that in Europe, specifically in Scandinavia, you have a much higher penetration of EVs. So we'll constantly be taking a look at Bilia to sort of see how they're doing in regards to their return on capital. And what we've noticed thus far is the return on capital hasn't declined. If it starts to decline, then that could be a concern. But at this point, they still seem to be holding up pretty well in regards to that aspect. So they're still generating a 20%, 27% annual return on equity. We've got good management sort of incentives here at Asbury. The company's background is it started out with a bunch of guys that were associated with private equity and roll-ups, and so they've got some experience in that area. Here's the current model with current updated information of where the market's going to go. They're expecting like 30% growth. This is stuff that's been basically the 2025 numbers here are numbers that are provided by management, and then also taking a look at where analysts think the numbers are, and so that they're roughly about the same. So what this is really showing is right now it's selling for a 4.1 times earnings. If these projections are realized, which I think management feels it can be realized, you're buying it today at 2 times 5-year forward earnings. And clearly, if this kind of growth is realized, then the multiple is going to go up. I think the real question here is, and so basically they build it up. This is sort of the buildup of how they get same store sales growth, M&A, and internet. You also have competitors that have a competitor called Lithia that has a similar kind of strategy that has a relatively high expected return from a revenue perspective. The one thing that's interesting about Asbury is you actually see some operational leverage in their operating income versus a lot of the competitors where the operating leverage seems to be much less. I think a lot of that has to do with their focus on clustering of dealerships. So this is again just sort of of where the company's at right now from a market perspective. And as you can see, right now, if we use, like I say, a modest 5% growth, and we use, let's say, the Graham formula of 8.5 plus 2G, we get an 18 times multiple. So if this thing trades an 18 times multiple 5 years hence, we're getting a 54% IRR, which is pretty good. I mean, even if we get half of that, that would be really good. So I think this is showing you from a quantitative perspective what the issue is here. Now, I guess with this type of return, you'd say, okay, well, what's the potential downside here? Well, I mean, I guess the potential downside is if somehow the business just the cash flows and the revenues just aren't there, which is tough for me to sort of come up with a scenario where that would really happen. Sans some kind of a huge event happening, making that happen. So here's an example in terms of here's where the current multiples are of these businesses. The one thing that's interesting to note is Asbury and Lithia have this sort of growth model, which is much higher than most of the other players in the marketplace, but their multiples are roughly the same now. And so what's happened is, whereas in the past, I think Lithia specifically was trading at a premium, Asbury, I don't think ever really got that premium. Right now, everybody, and they're actually trading at the low end compared to everyone else. So in essence, what you're getting when you're buying a company like Asbury is you're getting not only a cheap price, but you're getting a faster growth model and not having to pay for it. And so that's an example. So this is an example of sort of what's gone on. A lot of these multiples have come down just because of the cyclical aspect of the business. And so here's sort of a top level sort of framework right now. 4.1, 2.1 we talked about. If we use the Graham formula, these are just sort of some numbers that fall out of the formula. Clearly, you're going to get a combination of, if the projections are even halfway close, you're going to get a growing earnings, and the multiple should be higher for that type of growth given what's going on. And so this just gives you an illustration of the kind of situations we look for, where we've got a situation where we think both the underlying cash flow can grow and the multiple can grow based upon the growth rate that the company can generate from its operations. And so that's an example of Asbury. Now, the second example we've got here is another company, and this another aspect of this is sort of markets in transition, looking for companies going from one market to another. That's where you'll see a lot of these opportunities, because the market is uncertain about what's going to happen with some of these legacy players, and does give a good amount of value to the disruptor. And so the question is, how does this play out? If it plays out somewhere in the middle, right now, a lot of the incumbents are being priced really cheap. If it turns out somewhere in the middle, then you're going to end up with, I think, the incumbents going up. And we'll see how that plays out. But this two specific examples of this type of situation in terms of innovation changing the market is in consolidation, consolidated communication in terms of the telco / cable connectivity market, and Scripps in terms of the local TV market. And so you'll see sort of what's happening here. You'll get relatively low valuations on the incumbents. And it's tough to tell with some of these disruptors, because in essence, if they get close to they're always going to seem expensive because they're sort of ramping up at this point. But it's an interesting trade-off sort of between the two and how that sort of plays out in the end. Again, these kind of opportunities, just like Asbury opportunities, it gets what's called the Davis double. Now, this date, Shelby Davis was a famous investor in the 50s. And what he invested in is he invested in insurance companies in the 50s, when what had happened was the multiples were low, but there was a very large increase in revenue growth in the 50s and 60s. And so he got what was called the Davis double, which is an increase in both the underlying metric earnings and the multiple. And that's sort of what we're trying to capture with a lot of our with some of our situations that we're investing in here. And so there are some risks in this model, though. Part of the thing with the risk in this is sort of the transition timing, and the risk in terms of some of these legacy players is that will the decline in the existing market, will the growth in the new market not outpace the decline in the existing market, and you can get some volatility as a result of that. And debt can magnify the timing risk on this. And some of these companies are debt. They use debt as part of their capital structure, especially the communications types of businesses like cable companies and consolidated communications. So here's an example of so we'll go through Scripps. Again, sort of their focus is grow, consolidate, spin off, or sell, very similar to IAC, where basically we really like this model. We think it makes a lot of sense for companies. Their focus is local TV and nationwide network development. They do have a lot of spectrum that they can actually do. The very interesting thing about Scripps is if you look at what's happened here, Berkshire Hathaway had a purchase of Scripps. They bought Ion Networks in 2020, and Berkshire Hathaway, this was during the COVID crisis, Berkshire Hathaway financed that with a preferred security. Now, this is very similar to what Berkshire did with Cap Cities ABC. And when Cap Cities bought ABC, Berkshire basically financed the ABC purchase of Cap Cities, or the Cap Cities purchase of ABC. Now, they had known Tom Murphy, who had run Cap Cities before. And so this is a very sort of a rhyming situation here, which I think is very interesting. Now, it's not a huge position for Berkshire, so people probably aren't going to notice it, but it's a very interesting rhyming situation in terms of what's gone on in the past. So, okay, they've got a quad approach to growth. Local TV stations are sort of clustered, got a good amount of runway. And so again, these are sort of market stuff. I won't go into the specific details here, but the idea is that TV is transitioning to CTV. And what's happening is Scripps is using a combination of its local distribution network and its news portions of that, in combination with developing networks that basically can be viewed through CTV. And so it's basically doing a combination of those things, and then utilizing the spectrum. The key piece of the spectrum of local broadcast TV companies is it can provide a free alternative to distribute a lot of the content that's out there. And there is a way through ATSC 3.0 to basically have that provide a connected TV connectivity. So in other words, it can get the higher value CPMs by using that. And so that's an interesting, I think, sort of thing that's going on with a lot of these local TV companies. Like saying right now, when we did this, the CPMs for CTV were 3 times the linear pricing. And so what that means is that even if it shares a certain portion with, let's say, a Roku, they still can be ahead because the pricing is 3x. So that can become a win-win for both the content provider and owner and the local TV guys and Roku together. And so right now, the situation we've got is debt interest rates around 8.8, common stock trades at 3.7 times cash flow. Again, we have this combined earnings yield and growth of 30%, which is sort of a nice thing. The implied EBITDA is 7.8, and a lot of that's due to the debt. The challenges here could be evolving competition from CTV and the targets for local TV may not be as great as they have been in the past. Management is incentivized here. They hired a new CEO, just came in the past few years. I think he's incentivized and really focused on the CTV opportunity and ATSC 3.0 opportunity they've got. Here's sort of a forecast. I'm not really forecasting a whole lot of growth. You'll have the alternating years in terms of what's going on in terms of growth. The way that they figure this is that they're estimating a 10% network growth in terms of annually from the network TV business. Local TV and M&A is about 3 to 4%. Local annual growth is only 3%. Then you have this ATSC 3.0 opportunity. Now, none of that is reflected. These potential revenue drivers isn't really reflected in any of the numbers that we're showing here. There's a little slight bump in 24, 25, but after that, this is sort of a modest approach to this. And so there's some upside in this if some of these areas sort of play out. The interesting thing about all these local TV guys is that it's really tied to the election cycle, because what happens is there's a certain period of time where there's a large demand to get everybody's message out, and local TV is a great framework to do that. And these campaigns pretty much have to spend the money by a certain period of time, and that's a great way from somebody who has an opportunity for them to spend it, that they can do that. And so here's again just some relative multiples. You'll see they're all relatively low on a price to free cash flow. Now, what we've done here, and what we typically do with these TV businesses, you have to take an average of 2 years because the election cycle makes such a big difference with these businesses. And so that's what we've done here in terms of these numbers. You can see the numbers are just relatively low. So the market clearly thinks that implied growth number is showing you what the market implies that these businesses are going to decline. Now, if these businesses, especially with Scripps, with its network TV stuff, can stay the same or increase, then that's where the opportunity is. And that's where we think, the opportunity is with this particular company. You can also take a look at the free cash flow less debt yield. So that's saying, okay, this is what the debt market say, here's what the equity market says. With those high numbers, it's basically saying that the debt market thinks these companies are not, the incremental value of investing in equity is very high for these types of businesses. And finally, we've got the sort of the metrics as we talked about before, to sort of put this in perspective. If you got 3% organic growth, you add M&A and then ATSC 3.0, the multiples can be higher. And again, this is sort of the same thing that we try to look for. We try to look for businesses that are selling for modest multiples. If any of the growth paths that are out there happen, these businesses the multiples will increase along with the cash flow, free cash flow, or earnings will increase. And so these are just two examples of sort of what we have in the portfolio and what we try to look for. And those are the types of things that we've got right now. We've invested in another company that's similar kind of a setup called Berry Corp, which is a plastics company that's sort of consolidating. And from the other aspects is right now we're looking at sort of these interest rate plays. We'll sort of see what's going to go on with that, but that's probably at least what some of our thinking is now is to start to do that comparison of bond versus stock, which for the past 10 to 15 years really wasn't even a consideration, but I think should be more of a consideration for equity investors going forward, because looking preliminarily at some of these things, you can probably get, maybe high teens, low 20% rates of return, and all of a sudden that becomes competitive with stocks. And so that's primarily, some of our thoughts from that perspective. And if you guys have any questions, just let me know. Let me just see if I've got.
Oh, we have a question.
Okay.
Brian Langus, I think I've unmuted you.
Sure. Hi. Hey, Keith.
Hey,
How
how
you
you
doing?
doing, Brian?
Good, good. Good presentation. Thanks for doing that. Just a quick question. Have you ever looked at these bank loans, these short-term bank loans, the ETFs, or I lost you there, the ETFs or the closed-end funds? Some of them are trading at a discount to net asset values. They have a yield of, around 8%, and they have loans, and their portfolio are mostly loans that are maturing in less than 12 months. So the default rate is really low. But I don't know if you poked around a little bit.
No, those are really, like I said, those are interesting areas. I mean, I think where we've really focused has been more on some of the BDC stuff, which may be a little bit higher risk than those. I'm not sure what do you have any idea of what type of credit rating those loans have, or what type of,
It depends on the fund. Some of them have leverage in them. I know you have to poke at them, but BlackRock has a few, and they have floating rates and stuff like that. So you have,
I mean, BlackRock does have an interesting BDC called BlackRock Secured Lending, which does a similar sort of thing, where it's basically they have a very large amount of BDC type of situations. I think the things yielding like in the low teens. I mean, the advantage of these loans, like you're saying, is that right now there's going to be a huge bump. So LIBOR, the average LIBOR in Q2 was only 0.8%, or SOFR now, I guess. And if any of these loans, like you're saying, are tied to SOFR, which I think a lot of the commercial bank loans are, by the end of the year, so right now SOFR is 3. If by the end of the year it's up to 4, that's a huge increase in interest expense. The downside you need to take a look on those, though, is what happens to the coverage ratio. So Ares reported this morning. Ares is a very similar situation, but their coverage ratio went down from 2.5 to 2 just in this quarter. And so when the coverage ratio gets tight, that's what you need to really take a look at. And that's where you need, where I think if you're really confident in the underwriting process of the underwriter, that makes all the difference in the world. Because the guys that have written really good loans, those guys I think they're going to shine, because even if the interest rate goes up, I mean, the interesting thing about some of the ones that we've looked at is take a look at the industries that these loans are to. Are the industries growing, or are they mature industries that are sort of in the mature decline phase of their life? If it's the latter, that's where the risk happens, right? Because in essence, where you get more of a margin, and the margin of safety over time can go down as the economics deteriorates. But if the loans are in businesses that are growing, your margin of safety gets bigger in these loans. But yeah, I mean, I haven't looked at that one specifically, but I think that's definitely a great area to look at. But what I would recommend is looking at the underwriting and the specifics of the loans to get an idea of how solid, as SOFR increases, how solid is that going to be, and how is that going to turn into potential defaults and stuff like that. So
no, I was just looking at bank loans. They less than a year, so the default rate there's none. It's like 95% to 99%. There's no, they get paid first, right? And the bonds and So yeah, no, I was just walking around that. I wonder if you had an opinion on them. But yeah, that's all I got. Let somebody else.
I mean, I think the stuff that we've been looking at is similar. I mean, these BDC loans are like bank loans in essence. They're first lien secured. That's the stuff you're talking about for the most part. And they usually have equity and sub debt behind them. So in essence, that can create more of a buffer in terms of people that are going to take losses before you. There's actually some interesting CLO stuff that's like that too, where you get some of these CLOs. But the challenge I've had in CLOs is trying to find a manager whose fees are not super high. That's the challenge. At least I've been able to find. I don't know what the fees are on the fund you're looking at.
They're expensive.
What's that?
They're expensive.
Yeah. So I mean, that's always a trade-off you need to make in these things is okay, there's a great opportunity, but how much are you going to pay for it? I mean, you don't want to just not invest in it because it's too high, but you need to look at it on a net basis for the most part. So
Yeah, it's case by case because some of them use leverage, and you just have to be careful. You just have to know what you're doing.
yeah, I mean the leverage stuff can be tricky too if it runs into some refinancing type stuff to it, where the guy, if there's a credit, who knows what's going to happen over the next 6 to 12 months, but if there's some
Right.
type of an event that prevents companies from refinancing, that can create some additional risk from that perspective also. And if you're not levered, it's fine, but if you're levered, then that can cause some issues also. But I mean, a lot of it's I guess I would call it the art and skill of doing well, underwriting well, which you can take a look at the past record, and that's a great way to do it, but it's tough, I think, unless you really know the people involved, to really get a feel for how well the underwriting process is being done. But I think there's clearly some opportunity there. I think that's the big message just from the overall presentation is take a look at bonds and bond alternatives in addition to stocks, because they're becoming a lot more competitive than they were 12 months ago. 12 months ago, there was no comparison.
sure.
There hasn't been a comparison since for 10 years for the most part, right? So
At least.
Sounds like, Brian, thanks for joining us, and thanks for the question. Sounds like that's a great place to stop here. It's 11:01. I shared in the chat that we will share both the recording of this session and Keith's deck after the meeting. So, and hope to provide opportunities like this for continued conversations in the future. So Keith, thanks so much for leading this presentation, and everybody have a great day. Thanks for joining us.
Thanks a lot.